Two identical business owners earn exactly the same profit. One uses it to fund a growing empire. The other watches it disappear into the federal treasury. The difference is structure. Most entrepreneurs immediately register an LLC to shield their personal assets from lawsuits. But they stop there, assuming that legal protection automatically equals tax efficiency. It doesn't. Look at this diagram. If you run a standard single-member LLC that generates $200,000 in net profit, you have a problem. By default, the IRS subjects that entire amount to a 15.3% self-employment tax. That happens because the IRS considers a standard LLC a disregarded entity. For tax purposes, the corporate walls are invisible. Every dollar the business earns is treated as your personal income the moment it hits the bank account, even if you never actually withdraw a single cent. This creates a massive drag on what strategists call capital velocity. If you leave money in the business to fund an expansion or acquire a new property, you still pay a hefty tax penalty just for holding on to your own working capital. To optimize the speed at which your capital grows, you must separate your legal liability shield from your tax classification. The entity that protects you cannot be the same entity that determines how you are taxed. Let's apply this to an active consulting operation, which we will call the Education Company, LLC. It generates that same $200,000 in net profit. As a disregarded entity, that entire sum is trapped. The self-employment tax applies to every dollar, regardless of your personal labor input. The structural solution is to file IRS Form 2553, explicitly changing the tax classification of the LLC to an S corporation. This flowchart shows exactly what the S corp election does. It intercepts that $200,000 of profit and allows you, the owner, to legally separate the money into two distinct channels. The first channel is your W-2 salary. The IRS requires you to pay yourself what is known as reasonable compensation for the specific duties you perform, benchmarked against local market data. If market data dictates your executive labor is worth $80,000, you route that amount through payroll. This stream is subject to standard FICA payroll taxes. It pays the toll. The second channel is the K-1 shareholder distribution. The remaining $120,000 flows down this second pipe. Because this is classified as passive profit from your ownership rather than active wages for your labor, it entirely bypasses the payroll tax toll booth. By protecting that $120,000 from the 15.3% self-employment tax rate, you keep roughly $14,000 in your pocket every single year. The S corp election turns a rigid, mandatory tax assessment into a highly configurable system. You dictate the exact split between your labor cost and your ownership profit. Next, we incorporate the second arm of the enterprise, physical assets. We establish a new entity, Glanton REIC LLC, to hold investment real estate. Look closely at this warning graphic. You must never replicate the S corp strategy for your real estate holdings. Placing an appreciating asset inside an S corporation creates a severe tax hazard. If you attempt to transfer the property out of that corporate structure, or even refinance it to pull out equity, the IRS treats the transaction as if you sold the building at fair market value. You will be hit with massive capital gains taxes on phantom income you haven't actually received. The rule is absolute. Real estate must always remain isolated inside a standard, disregarded LLC. Let's look at the financial output. Over 12 months, Glanton REIC generates $120,000 in positive cash flow from tenant leases. To shield that cash, we apply a process called cost segregation. An engineering study identifies specific components of the property, like flooring and appliances, that degrade much faster than the building's physical structure, allowing us to accelerate their depreciation schedules. This triggers a mathematical inversion. You collect $120,000 in actual cash, but because of the heavy front-loaded depreciation, you report a $15,000 loss to the IRS on paper. If you log enough hours managing these properties to qualify for real estate professional status, the tax code allows that $15,000 passive loss to flow upward and directly erase taxes owed on your active consulting income. Furthermore, the remaining eligible income from the consulting side receives an automatic 20% haircut under Section 199A for qualified business income. When isolated in the correct legal structure, real estate operates as a targeted mechanism to erase your federal tax liability across the entire portfolio. Zooming out, the complete enterprise architecture relies on 3 tiers. A family trust at the apex, which owns a central holding company, which acts as the parent to both the active S-Corp and the passive REIC. Warning tone. This entire multi-tiered design possesses zero structural integrity if your daily financial administration is sloppy. Opposing counsel looks for one specific error: commingling. If you treat these multiple companies as a single, centralized bank account, a judge will pierce your corporate veil and collapse your liability shield. Look at the structural walls here. The first rule of the administrative fortress is that every distinct entity must apply for and maintain its own unique employer identification number. Rule 2 is that those separate identification numbers mandate strictly isolated bank accounts. You cannot legally pay for a property rehabilitation expense out of the consulting firm's checking account. Each subsidiary must stay in its operational lane. Only the S Corporation manages W-2 payroll. Only the REC collects rent and handles property maintenance. Managing this web of ledgers requires offloading the complexity to a dedicated professional team, utilizing institutional-grade bookkeeping and tax services to track every transaction. Pristine bookkeeping proves to the IRS and the court system that your legal boundaries are real, preventing your shield from collapsing under scrutiny. This diagram illustrates the ultimate goal of the structure, forcing your actual cash and your taxable income to run on 2 separate tracks. Track 1 represents your physical liquidity. Track 2 represents your IRS liability. On the liquidity track, the S-Corp's $120,000 distribution and the REIC's $120,000 in tenant cash flow physically move up the chain, pooling together into the holding company's central bank account. Vaulting that $240,000 in the holding company shields it from any lawsuits directed at the subsidiaries and creates a secure pool of dry powder for your next real estate acquisition. Now look at the liability track. The pass-through tax codes ignore that physical vault completely. Instead of taxing the pooled cash, the IRS traces the specific character of each dollar. Your $80,000 W-2 salary, the $120,000 FICA-exempt K-1 distribution, and the $15,000 Schedule E paper loss all bypass the holding company, landing directly on your personal Form 1040. Look at the final math. The enterprise physically generated and banked $320,000 in cash. But through deliberate routing, depreciation, and strategic elections, the IRS calculates a taxable baseline of only $185,000. A disparity this large is mathematically impossible if you operate a single default LLC. It requires an architecture designed specifically to decouple liability from liquidity. Advanced tax planning does not rely on hiding wealth. It relies on openly routing your capital through the exact legal channels the federal government established to reward operational velocity and generational asset protection.